Riding the bull, a time for optimism. Wall Street, a place of boom and bust. Fortunes made and lost. We've all heard the stories. But what drives these dramatic shifts? Enter the bull and the bear, symbolic beasts that represent the market's ever-changing moods. A bull market is a period of rising stock prices. Think of a bull charging forward, horns thrust high. It's a time of optimism. Investors are confident, putting their money into the market, expecting their investments to grow. Prices climb higher, fueled by this buying frenzy. The economy hums, unemployment is low. Everyone wants a piece of the action. The roaring 20s, the dot-com bubble. These are classic examples of bull markets in action. During these periods, the stock market soared to dizzying heights. Investors rode the wave, their portfolios swelling with each passing day. Excitement filled the air. People quit their jobs, convinced they could make a fortune trading stocks. New technologies emerged, promising to change the world. It felt like the good times would never end. But as with all things, what goes up must eventually come down. The music stops, the party ends, and the bull, exhausted from its relentless charge, finally takes a breather. The market enters a period of correction. Some investors choose to cash out, taking their profits. Others hold on, hoping for the bull to regain its footing. But the mood has shifted. Uncertainty creeps in, casting a shadow over the once bright outlook. This is the nature of the market, a constant cycle of ups and downs. And understanding this cyclical nature is key to surviving and even thriving in the world of investing. The bear growls, retreat and reassess. Now, let's talk about the bear. Unlike its bullish counterpart, the bear represents a time of decline. When the bear growls, the market listens. Stock prices fall, and fear begins to grip investors. The economy slows, unemployment rises, confidence evaporates. It's a time for caution, for battening down the hatches and weathering the storm. The Great Depression, the 2008 financial crisis. These are stark reminders of the devastating impact of bear markets. During these periods, stock prices plummeted, wiping out savings and shattering dreams. Businesses crumbled, unable to secure the loans needed to survive. Fear and panic spread like wildfire. It felt like the world was falling apart. But even in the darkest of times, opportunity emerges. Savvy investors know that bear markets offer a chance to buy low. With stock prices depressed, bargains abound for those willing to take the risk. Of course, timing the market is notoriously difficult. No one knows for sure when the bear will retreat and the bull will return. But by understanding the cyclical nature of the market, investors can position themselves to capitalize on both the upswings and the downswings. It's important to remember that bear markets are a natural part of the economic cycle. They may be painful in the short term, but they also serve a purpose. They weed out weak companies, forcing businesses to innovate and become more efficient. And they create opportunities for new leaders to emerge. The key is to stay informed, remain calm, and stick to your long-term investment strategy. Spotting the signs, economic clues. So how do we know when the market is shifting from bull to bear or vice versa? While predicting the market with absolute certainty is impossible, there are economic indicators that can provide valuable clues. These indicators, like the vital signs of a living organism, can offer insights into the health of the economy and the direction it might be heading. One key indicator is gross domestic product, GDP, which measures the total value of goods and services produced in a country. A rising GDP typically signals a strong economy, which can fuel a bull market. Conversely, a shrinking GDP can be a harbinger of a bear market. Another important indicator is unemployment. Low unemployment generally indicates a healthy economy with plenty of jobs, which can boost consumer spending and drive stock prices higher. On the other hand, rising unemployment can signal an economic slowdown, leading to decreased consumer confidence and a potential bear market. Inflation, the rate at which prices for goods and services increase over time, is another crucial factor to watch. Moderate inflation is considered healthy for a growing economy. However, high inflation can erode purchasing power and lead to economic instability, potentially triggering a market downturn. Interest rates, set by central banks, also play a significant role in shaping market conditions. Low interest rates make it cheaper for businesses to borrow money, which can stimulate economic growth and support a bull market. Conversely, high interest rates can slow down economic activity and contribute to a bear market. By keeping a close eye on these economic indicators, investors can gain a better understanding of the overall market sentiment and make more informed investment decisions. Remember, knowledge is power, especially in the unpredictable world of finance. The Investor's Playbook: Navigating the Wild Ride. Now that we have a better grasp of bull and bear markets, let's discuss how investors can navigate these turbulent waters. The key is to have a well-defined investment strategy and stick to it, regardless of market conditions. This means determining your risk tolerance, investment timeline, and financial goals. Are you a risk taker comfortable with the ups and downs of the market, or do you prefer a more conservative approach? Are you investing for the long term, such as retirement, or are you looking for short-term gains? During a bull market, it's tempting to chase returns and jump on the bandwagon of hot stocks. However, it's important to remember that not all bull markets last forever. Diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, such as stocks, bonds, and real estate, to mitigate risk. It's also crucial to conduct thorough research before investing in any company. Look beyond the hype and analyze the company's financials, management team, and competitive landscape. When the bear comes knocking, it's easy to panic and sell everything. However, remember that bear markets are a natural part of the cycle. Instead of reacting emotionally, take a deep breath and reassess your investment strategies. If your financial goals and risk tolerance haven't changed, there's no need to make drastic moves. In fact, bear markets can present excellent buying opportunities for long-term investors. As the saying goes, buy low, sell high. Another important aspect of successful investing is emotion management. Fear and greed are powerful forces that can cloud judgment and lead to poor decision-making. Don't let the fear of missing out drive your investment choices during a bull market. Similarly, don't let panic selling dictate your actions during a bear market. Stick to your strategy, trust your research, and don't make impulsive decisions based on short-term market fluctuations. Understanding market moods: a recipe for success. In the world of finance, understanding the ebb and flow of market sentiment is as crucial as understanding the companies you invest in. Bull and bear markets, like the changing seasons, are inevitable cycles that shape the investment landscape. By recognizing the signs, managing your emotions, and adhering to a well-defined strategy, you can navigate these cycles with greater confidence and potentially profit from both the upswings and the downswings. Remember, investing is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and riding out the inevitable market fluctuations. By understanding the dynamics of bull and bear markets, you equip yourself with the knowledge and perspective needed to make smarter investment choices and work towards your financial goals. Whether the bull is charging or the bear is growling, remember that knowledge is your most valuable asset. Keep in mind that this is just a brief overview of a complex topic. There's much more to learn about bull and bear markets, economic indicators, and investment strategies. I encourage you to continue your education, seek advice from financial professionals, and never stop learning about the ever-evolving world of finance. After all, the more you know, the better equipped you'll be to navigate the exciting and sometimes daunting world of investing.